Welcome to the deep dive. Today, we're cracking open the latest numbers from eClerx Services Limited,
That's right. We're looking at their unaudited, consolidated financials.
specifically for Q2 and the first half of fiscal year 26, so the period ending September 30th, 2025.
And, this isn't just a standard quarterly update. There's quite a bit going on here.
Yeah, it seems like it. The source documents show this interesting mix, right? Growth, efficiency.
Exactly. Aggressive operational growth balanced with strategic internal moves. And it all leads up to a pretty major decision on cash.
Right. That decision, the capital allocation piece, that's often the real signal, isn't it?
It absolutely is. Tells you how management sees the business's value beyond just the immediate numbers.
So we've got this story unfolding. Robust revenue, expanding margins.
And this bold strategic move on returning capital. A buyback.
Okay, let's unpack this. Where should we start? The financials.
Let's start there. Core performance in Q2. What did the headline revenues look like?
Okay, headline revenues.
Well, the growth was definitely robust. Operating revenue, OPG, in U.S. dollars hit $115.5 million for the quarter.
And in rupees.
Total revenue came in at INR 10,352 million. That's about 1,035 crore.
And year over year, how does that compare?
Pretty strong. Total revenue jumped 22.6% year on year.
Okay.
But, for really understanding the core business strength, we need that constant currency number.
Right. Explain that for our listeners. Why is constant currency so important here?
Because it basically strips out all the noise from exchange rate swings. It shows you the genuine underlying demand.
Makes sense.
And for Q2, the year-on-year constant currency growth was 16.3%.
16.3%. So the underlying engine's running strong.
Exactly. Regardless of, what the dollar or the rupee is doing day to day.
Okay, that's solid growth. But the really eye-popping part seems to be the profitability, right?
Yes, this is where it goes from sort of good to great. That 16.3% CC growth is nice, but the margins.
Wow.
Yeah.
So what happened with EBITDA?
This is the real aha moment, I think. EBITDA shot up to INR 2,983 million.
Correct.
Which is a massive 27.1% increase, just quarter over quarter.
27% quarter over quarter. That's huge.
It is. And the margin percentage itself jumped to 28.8% in Q2. That's a gain of 399 basis points, again, quarter over quarter.
399 basis points. So nearly 4 full percentage points of margin expansion in just 3 months.
Exactly.
That significantly outpaces the revenue growth we just talked about.
Precisely. It signals something major changed internally. It can't just be luck.
No, definitely not. So are they squeezing costs really hard, or is it more about selling higher value services? What does the data suggest?
Well, the operational data we'll get into definitely points towards a big push on efficiency and maybe tightening things up. But it's often a bit of both, isn't it?
True.
And we know this efficiency hit the bottom line. Net profit was INR 1,832 million. That's up 30.6% year over year.
Impressive. And EPS?
Yeah. Basic earnings per share for Q2 FY26 climbed to INR 39.0. Compare that to INR 29.7 in the same quarter last year.
Okay, so that margin expansion is clearly key. Let's connect that profit surge to the operations side. How are they managing the scale, headcount?
Well, they're managing some serious growth. As of September 30th, total headcount was 21,415.
Over 21,000 people.
Yep. And the delivery headcount specifically saw an 18% increase year over year.
18% growth in delivery staff? While simultaneously boosting margins like that, that's a tough balancing act.
It really is.
Did their efficiency metrics hold up under that pressure? Utilization?
They did. Actually, they improved. Staff utilization for delivery hit 75.1% in Q2.
Okay.
Which is a noticeable step up from 72.8% in the previous quarter, Q1.
Ah, so that's crucial. They absorbed the new hires and got more out of everyone.
Seems like it. That directly fuels the margin gain we saw.
Makes sense. What about retaining staff? Attrition's always the big headache, right? High turnover can kill those efficiency gains fast.
All right, so offshore voluntary attrition was 20.3% for Q2.
20%? How does that track?
Well, it's actually a bit higher than Q1, which was 17.6%.
Okay.
But, and this is the important context, it's way down from Q2 last year. Last year, it's 28.8%.
Ah, okay. So year over year, the trend is still towards stabilization, even with that quarterly tick up.
Exactly. Stabilizing even while growing headcount rapidly.
Let's pivot a bit. Market focus. Where is this growth coming from geographically? Client mix.
Yeah, they seem to be doubling down on their strengths.
Yeah.
North America's contribution to revenue grew.
How much?
It jumped to 80% in Q2 FY26. That's up from 76% the year before.
80%. 80% from North America. Wow.
Europe.
Europe consequently dipped a bit, down to 14%.
80% from one geography. That drives focus and maybe helps those margins, but doesn't that also ramp up concentration risk?
It absolutely does. You're right. It's a successful strategy right now, clearly, but it means management has to be really watchful about that market.
On the flip side, within their industry verticals, there's maybe a little more diversification happening. BFSI banking, financial services, insurance is still the biggest, but its share dipped slightly. Meanwhile, the emerging segment, that showed really strong growth.
How strong?
It went from 4.7% of revenue in Q2 last year up to 7.7% this Q2.
Okay, so finding some new niches, even if the geographic focus is very sharp.
Seems that way. Applying their services to new areas.
All right, now let's get to that big corporate strategy piece. The capital allocation. That buyback signals some serious confidence, doesn't it?
Oh, absolutely. On October 24th, 2025, the board greenlit a pretty significant share buyback.
How are they doing it? Tender offer.
Yes, via a tender offer route.
And the specifics? Size, price.
The proposal is for an amount not exceeding 300 crores rupees. That's INR 3,000 million.
3,000 million, okay.
At a price of R 4,500 per share. Of course, that's subject to shareholder approval.
4,500 per share. That's a hefty premium. What gives them the firepower to do that? Their cash position must be strong.
Exceptionally strong. Consolidated cash and cash equivalents was INR 5,940 million at the end of Q2.
Nearly 6,000 million in cash.
Yeah. And get this comparison. The current book value per share is around INR 533.
Okay.
But the cash and cash equivalents per share is INR 12,202.
Wow. So the cash they hold, just the cash, is more than double their entire book value per share.
Pretty much, excluding all other assets. It's a massive cash pile.
So proposing a buyback at 4,500 rupees when over 1,200 of that is just sitting there as cash per share.
Yeah.
That says management thinks the market is seriously undervaluing the business's future earnings.
It's about the strongest signal of confidence a board can send, really.
Definitely. Now, we should also touch on something else that boosted the numbers this quarter, maybe unexpectedly. Foreign exchange.
Ah, yes, the currency impact. That was quite significant this time, a real tailwind.
How big are we talking?
Well, they reported revaluation income of INR 186.1 million in Q2.
Okay. And last year?
Just INR 1.4 million in the same quarter last year.
Whoa. That's a huge difference. What drove that?
Simply the U.S. dollar strengthening against the rupee. The exit rate for Q2 was 88.84 rupees to the dollar, compared to 85.79 at the end of Q1.
Got it. So a stronger dollar gave a nice, if maybe temporary, boost to the rupee results. Are they hedged against future swings?
They are, yeah. They've got outstanding hedges totaling about $249 million. All in forwards, locked in at an average rate of around 88.04 per dollar.
Okay, well protected there. And one last thing before we wrap the main story, there was some internal restructuring mentioned.
Yeah, just a quick note. The board mentioned the merger of ASEC Group LLC into Personiv Contact Centers LLC. That took effect October 1st.
And the reason?
Just for, quote, efficient corporate structure. Importantly, no cash changed hands, no new shares issued, purely an internal cleanup.
Right, simplifying things. Okay, so pulling it all together for Q2, the narrative seems clear. Great operational execution driving fantastic margin growth.
Helped along by some currency tailwinds.
And all that success and cash generation is fueling the confidence we see in this big buyback proposal.
Exactly. If you connect it to the bigger picture, the company's basically signaling its house is in excellent order. High growth, tons of cash, and a clear focus on rewarding shareholders while keeping that operational machine humming.
Which, brings up a really interesting final thought for you, the listener, to maybe mull over. They just did that internal restructuring, right? The non-cash cleanup for an efficient corporate structure.
Yes.
They're sitting on this mountain of cash, that INR 12,202 cash per share, and they're still heavily concentrated 80% in North America.
Right.
So the question is, does that internal cleanup signal they're maybe prepping for something bigger? Could a significant acquisition be next, maybe to diversify, using that cash? Or is this big buyback the main event for capital deployment for now?
That's a great question. Is the buyback the whole story or just Act 1, given the cash and the recent tidy-up? It's definitely something to watch.
Something to ponder as you track their next moves.